Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Thanks for joining us on The Bigger Picture with me, Ryan Huang. Now, we've seen more signs of trade tensions easing, but is the worst over? And what are some of the competitive advantages of companies you should be looking at? Well, helping us out this morning is Adam Wong. He is the editor-in-chief for the Fifthperson. Good morning, Adam. How are you doing these days?
Good morning, Ryan. Thank you for having me.
Yeah, how will you describe the market environment as we see all these headlines going back and forth about trade tensions, trade deals? What have been the latest you've been observing in the markets?
I think the thing with this whole trade war thing with Trump is that it's really unpredictable. I think the uncertainty is the main thing for me. We don't know what's going to happen next. But it seems like things are clearing up. And when we look at companies, we want to see as investments, you want to see whether that company is more or less insulated despite the tariff uncertainty that's out there. So, for example, Nike is one company that is kind of affected by the tariffs because a lot of their footwear, 50%, is manufactured in Vietnam, which has tariffs. Of course, if that could change overnight because Trump is so unpredictable. But at this point, this is an example of a company that is directly affected by tariffs, and earnings have come down because of that for them.
Yeah, in the latest earnings season, we have seen quite a few of them either withdrawing their guidance or cutting back what they are projecting because it's so tough to forecast, so tough to budget. Hiring, spending, and all that really is thrown up into the air. So that really goes to the point of how difficult it is to make decisions in the markets. And I think investors will be trying to figure out, where do they go from here? What's the best way to approach markets? And I suppose one way to look at it is to find some of the more defensive qualities in stocks or companies to focus on. And to that point, pricing power is one of them. Does, for example, Nike have that trait?
I think Nike has some form of pricing power because of the brand equity in the sport apparel market, but it's not strong enough to insulate itself fully from the impact of tariffs. So Nike itself has already said that the tariffs are going to impact us, and we have seen their earnings come down quite a bit, 26% in the most recent quarter. But an example of a company that really has pricing power would be an ultra-luxury brand, for example, like Hermes. So Hermes is a brand that, no matter what, if prices go up, I think people will actually enjoy paying more for it, for example, right? So this is a clear example of a company that has pricing power. And Hermes itself has already said that, hey, the tariffs are going to hit us, but we're going to raise prices for a lot of our products as well. So if you want to buy them, prices are going to go up. Take it or leave it. And I think people who love luxury are just going to pay for it.
Yeah, I think spending in the luxury space is still quite resilient in tough times. And that goes to your point of how that could be a place to look at when it comes to strong pricing power. All right, another place to look at is profitability. So where are the companies that you should be looking at more closely on this front?
The other thing you want to look at is profit margin and gross margin. So if a company has higher margin, they have more room to basically absorb the impact of tariffs because then the cost could go up, but then they still have a large enough margin to earn a decent profit. So Apple is one example. They are not insulated from the tariffs because they do a lot of the manufacturing in China. They have some exemptions at this point, which actually is great for the company. So Tim Cook has done a great job at negotiating to make sure there are a lot of critical imports for Apple hardware is exempted from the tariffs. But Apple has a very healthy gross margin for a company in this sector, in this industry. So around 40-50%, which is very high for a hardware company. The other thing about Apple is that they also have a services segment, which is very high margin compared to its hardware business. So the higher your gross margin or profit margin is going to help with insulating from the increased cost, and then you still have some leftover for the company to remain profitable.
Yeah, when you look at profitability, do you also take into account the consistency of their margins?
Yes, so you want to see a company like over the last 5-10 years, their gross margins and net profit margins are very consistent. So this tells you that they have, in a sense, pricing power because then the prices don't fluctuate, demand doesn't fluctuate. They're able to sell a consistent amount of products or services every single year. There's predictability to its business model. So you want to see that in the gross margins and its revenue and cash flow. That gives you more certainty in uncertain times.
All right, I guess that goes also to the point of how resilient their supply chain is. All right, let's take a look at also another area to look at, which is where perhaps investors or consumers, whether they can do without the product. I'm wondering if Netflix falls into this category.
No, I don't think so. No, Netflix is not something I would consider non-discretionary. I think this is something that I can stop watching Netflix if they increase prices too much. But a non-discretionary product could be your essentials and your staples. So one great example of this is Costco. So Costco is a bulk retailer, right? Discount retailer in the U.S., very successful. If you take a look at Costco's share price year to date. It has gone up 9% despite all the tariffs. And they're a company that actually imports products from overseas. So they are actually going to be somewhat affected by the tariffs, but they've done so well so far. And the reason is because no matter what, if the economy gets worse, recession comes, people are going to need to shop for essentials still. And Costco is probably one of the best places to go if you want to save money. It's a discount retailer. You can buy very cheap products in bulk. And I would think a lot of people will still continue to shop at Costco, if things get bad. So I think Costco has done so well so far.
Okay, so on a local basis, would it be Sheng Siong in a sense?
Yeah, you could say something like Sheng Siong. I think Sheng Siong is an example of during the pandemic, it was a company that did so well during COVID because it was such an essential company for so many people here. That is one example in the local area. Yeah.
Okay, so the defensive names, utilities also come to mind. The telcos, would that be also part of the equation?
Yeah, telcos would be. You have to have a look at the situation for the telcos. So, for example, in Singapore, there's a lot of competition for telcos. So, as a whole, may not be a great investment because of the competition, the price wars between the telco companies here. But in a sense, if their business doesn't rely on imports or tariffs, then it's insulated from the tariffs on that front. But then you got to analyze the rest of the business and see whether it's still a good investment.
Okay, so we have tariffs going on, and this also has seen a lot of them trying to rejig the supply chains, the factory footprint, and so on. So what's the play here when you are considering where they operate?
Yeah, so if you really want to be very conservative here, you can look for a company that has very localized supply and demand. So it doesn't really have a supply chain that requires you to import and then you get hit by tariffs, or it doesn't really require you to export your products to the US and then you get hit by tariffs again. So stuff like that, if you have a localized company and it doesn't care about any trade in or out, then the tariffs don't affect you at all. One example could be a REIT. All right? A REIT is basically your landlord. You don't have the land going in and out of the borders. You basically have your tenant coming in, you rent the place, and then the landlord earns some money. So the tariffs don't affect the REIT at all in this example.
All right, so less moving parts in a sense. It's clearer, more predictable. So those are some of the competitive advantages that can help shield companies during trade wars. And helping us out this morning, Adam Wong. He is the editor-in-chief for The Fifth Person. Adam, thanks so much for your time and insights.
Thank you for having me, man.
Great having you on. All right, catch up again soon. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.